Welcome to Cedarstone's presentation of fundamental investing. This is Matt Davis, Vice President here at Cedarstone, and today we will be reviewing a strategy that is very core to the way we invest. To quote Michael Jordan, the minute you get away from fundamentals, whether it's proper technique, work ethic, or mental preparation, the bottom can fall out of your game, your schoolwork, your job, whatever you're doing. I would argue that this quote is very applicable to your investment portfolio as well. Let's take a look at what I mean. What many people don't realize is that the S&P 500 is an index representing the 500 largest companies on the New York Stock Exchange and NASDAQ and is weighted according to their market cap or size of the company. While typically the size of a company does imply how well a company has been doing, it is still just one statistic. A simple analogy would be picking a basketball team. While obviously having tall players is an advantage, size alone would not be enough to pick a successful team. Here we have a list of what your team would look like if you used only height for your selection process. For those of you who are not basketball inclined, most of these players are at best decent role players, and in fact, Sim Buehler, the tallest player we have, has yet to even play a single minute this year. I am sure it'd be interesting to watch a team that was so large play, but I think it is a fair guess that this team would not perform very well. On the next slide, we go ahead and repick our team. But instead of using height alone to make our selection, we use the player efficiency rating model derived by John Hollinger, a former ESPN analyst. Hollinger uses multiple statistics to build his model, including field goals, three-pointers, rebounds, assists, blocks, steals, and then subtracts out for negatives such as missed shots, turnovers, and fouls. By using a more comprehensive approach, the result is a much more impressive team. Again, for those who are not basketball inclined, this would be an incredibly talented team on the floor. So how does this apply to stock picking? Well, we believe in using a similar model that takes a deeper look at the company to decide its weighting in our portfolio. Here we use the example of Target. Instead of using points, steals, and rebounds, we use sales, cash flow, dividends, and book value to determine what we believe is the appropriate weighting in our strategy. If you look at the bottom of this slide, you will see the cap weight is equal to 0.2%. So this is how much the S&P 500 is made up of Target shares. However, when we do our simple analysis of sales, cash flow, dividends, and book value, we believe that Target deserves a larger portion of our portfolio because of their robust fundamentals. So with just those four factors, we believe that the overweight to Target should be to 0.45% of the portfolio. And actually, if we employ our more sophisticated model we have for our portfolios that go beyond those four factors, we actually have a 0.69% weighting in our current model. So why is this important? Well, first, I think it's worth saying that even though the S&P 500 uses an incredibly simple formula for its construction, it is still really difficult to beat. If you look on this chart, over the past 5 years, 87% of the US large cap funds have actually underperformed their benchmark. That means that before we try to deviate from their selection process, again, in this cap-weighted, simple weighting process, we need to have a very high amount of conviction in our ability to beat this index. So, how has it worked historically? On this slide, we can see an inception date of 1962, and again, that's this first line for the FTSE RAFI 1000, so that's the fundamental index, and it's against the S&P 500. You can see that in parentheses, and we can see that it's added 2% of value annually. This doesn't mean it happens every single year, but it does mean that over the long term, this has consistently added value. You can see on the next column over is its 3-year win rate is 75.3%. This isn't meant to outperform every single year, but we do believe over the long term, this is a fantastic way to boost your equity returns. So why does this strategy work? As you can see on this chart, part of its success is to stay away from bubbles in the market. In the years prior to 2000, as you can see, it actually underperforms in orange. The reason for this is that the market became irrational, or as Michael Jordan put it, the market got away from fundamentals. And when the bottom fell out, our fundamental strategy performed extremely well following 2000 because the weightings of the portfolio were more heavily in favor of those who had strong balance sheets and cash flow. I appreciate you taking the time to learn about fundamental investing, but it's something we are very passionate here about Cedarstone. If you have any questions, would like to dive deeper into this, or looking for any other information, please never hesitate to reach out. Thanks.